I welcome you to the Q3FY18 Siti Networks Investor Relations conference call. We have with us Mr. Rajesh, who is the Chief Business Transformation Officer for Siti, and Sanjay, who is the Chief Financial Officer for Siti. I now hand over the call to Rajesh to brief us about the Q3 and the 9 months results.
Good afternoon. Thanks, Ankit. Good afternoon, ladies and gentlemen. Thank you so much for taking your time out and joining us on the call. Fantastic quarter for us. Some of the key highlights. Our operating margins have improved by 85% quarter on quarter, taking it to 50 crores, which is 225% increase year-on-year basis. EBITDA margins have improved by 614 beeps, 614, going to 14.8%. Happy to share that our overall revenue grew up by 30% year-on-year and 8% quarter-on-quarter to 337 crores. Subscription revenue, which is a key driver within the overall revenue, it went up by 44% year-on-year, taking it up to 212 crores. Despite that, we had a fantastic last quarter where our subscription revenue had increased by 21%. So it's a further jump of 3% on previous quarter. Our expense ratios have significantly improved. When I look at my expense to operating revenue, my expense ratios, it has improved. It is 85% now versus 91%, which is used to be in last quarter. So an improvement of 6%. Collection efficiency, which has been a key focus area for us, it has been at 95% for Siti Networks Limited, and YTD average of 90%. So these are the few key highlights, and I leave the floor open for you guys to join us on that.
Yes, we have kept the floor open for queries, so we'll just wait for the question queue to assemble.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Avinash Kumar from Moon Capital. Please go ahead.
Yeah, hi, good morning all. My first question will be in 2 parts. I'll ask one by one. I can see that your activation revenue is down sequentially and also on a Y-on-Y basis. And also the pace of your net cable subscriber addition has slowed down in this quarter. It is down to 0.22 million from 0.50 million now this quarter. So what I want to understand is the company facing any competitive pressure in the cable market? And in which region, if you can spy, is it phase 1 or phase 2 or phase 3 markets? Where is the competitive pressure coming from? That's first part of the question. Second part is, if I calculate your activation revenue per box, I can see that it has come down on a quarterly basis. So what I want to understand is the company undercutting STB activation revenue due to the increased competitive pressure, and still it is not able to gain new cable subscribers? So if you can answer this, then I can move to next question.
So you already asked 2 questions, Avinash, out here. One, you are talking about you're talking about net additions or gross additions when it comes to set-top box additions. And then your second question is what is the activation number. So first of all, my activation revenue has gone up and not down. My quarter-on-quarter activation revenue, quarter 2 was 743 and quarter 3 is 761. So I don't know from where you are coming saying that activation revenue is down. That's one. Second, yes, obviously, while we all were heading up as an industry, we all were converting analog to digital. The pace of adding set-top boxes was much stronger compared to what it is today. And the clear reason is that the whole digitization wave is at its last cusp. So while we added up close to 2.6 million boxes YTD in 9 months, but when I look at this quarter we added up around 4.6 lakh boxes. Wherein we also had a churn of around 2.4, leading it to net addition of 2.2 lakh boxes. Now, when you talk about competitive pressures, obviously the most of the seeding has been happening in phase 3 and phase 4, and not in phase 1 and phase 2. And everyone is trying to do that. So that's the competition is the norm of the game and nothing extraordinary.
Okay. Now, if you see your activation revenue, that is you have reported yesterday, your Q3 revenue is activation revenues 277, whereas in Q2 it was 411. So it is down sequentially around minus 37% and YOY only 41%. This is where I got the numbers from.
See, Avinash, the numbers that we report are Ind AS numbers, right? And obviously there's a bit of spreading out of the revenues over a active life of the customer, as well as there is some backup revenue coming from the previous year's seeding as well, right? So what the numbers that Rajesh has told you is based on the IGAP revenue and on the gross boxes that we have seeded on a quarterly basis.
Okay. So I guess India S is the correct number to look at. I mean, going forward, that will be on a comparable basis, if I'm right.
IGAP would be the correct number to look at, because that is like it is giving you the revenue that you've seeded X number of boxes, and this is the amount of revenue that you're getting for X number of boxes, and based on that you get a per box rate.
Okay.
So Sanjay here. So what Ankit is trying to say, when we talk about IGAP, what we are looking at is the 100% of the collection under the activation head. But what gets reported is under India is a mix of 65% of my current activation, as well as there's some catch up from the previous quarter.
Right. I got your point. Right. Okay. So, I mean, there is no extraordinary competitive pressure the company is facing, and my point is there is no undercutting happening when it comes to activation fees per STB, just to gain some extra subscriber. I mean, something like that happening on ground. Is there
nothing significant, Avinash?
Okay. That's all. Now, the second question is, I mean, I can see that your net content cost, I'm talking about net content cost per subscriber has gone down this quarter, which is a good thing. So what I want to understand is this sustainable or is it a timing issue? And where can we see your net content per subscriber by, let's say, by this fiscal year end?
See, content cost is something which is one of the key focus areas for us. There have been deals which are open right now. We are under negotiation with some of the key broadcasters, and there would be an uptick in content cost next quarter as those deals come into play.
If you can help me with some numbers.
Sorry to interrupt, Mr. Kumar. So may we request that you return to the question queue? There are participants waiting for their turn.
Sure. I'll return to the queue. Thank you so much.
Thank you. We'll take the next question from the line of Sanjay Chawla from JM Financial. Please go ahead.
Hi, good afternoon. Thanks for the opportunity. I've got two questions. First one is on your carriage and placement revenue, which seems to have seen quite a good uptick this quarter. So what is driving that, and is this sustainable? And on a full year basis, how should we look at the growth, let's say in fiscal 19? That's on the carriage and placement. And second question is on the content cost. You mentioned that some deals are open and we should see some uptick. So can you just share with us the timeline of the negotiations which are due in this calendar year, calendar 18, and how much growth one could realistically factor for FY19 on the pay channel cost?
I think this question has been repeatedly asked, Sanjay, by you whenever we have discussions. Answer is same. When you talk about the increase in content cost increase is pegged around 15% per annum basis, and we maintain that. And as you yourself have said that there are some deals which are under negotiation, and obviously there will be an impact. So we still maintain 15% consistent impact on annualized basis when it comes to content. With regard to carriage revenue, yes, there has been improvement because we had done a couple of new deals, and there has been some impact of some carriage catch-up due to those deals. It's an item we have to look at on a yearly basis, and there will be always quarterly variations.
So what is the exact pay channel cost this quarter?
In the sense?
In the sense, just the pure content cost.
The content you're asking about?
Yeah, pure content cost.
1,500 million, 1,542, I guess. It's 1542, yeah.
1542. So even if we look at this number for, let's say, 9 months of this year, we have seen a growth of more than 20% in the content cost. Why? So my question is,
when I look at, you're talking about YO, that's more of a timing issue.
No, I'm looking at 9 months.
I always maintain, obviously, because there is the content deals always happen anytime within the 12-month period. So when you look at FY18 gross content payout cost, it will be the same. It will be in the high teen basis. This is what we have been always maintaining. It will not cross that.
Okay, all right. Thank you.
The timing issue, nothing else.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is from the line of Mayur Gatani from OHM Group. Please go ahead.
Hi, thank you for the opportunity. I'm just a bit confused. Your reporting number says, the press release says 49 crores of operating EBITDA. So is that excluding the activation income?
Oh, yeah, it's operating EBITDA. No? Operating EBITDA is always EBITDA excluding activation. It's not 49, it's around 50 crores.
Okay, and the operating is approximately total reported is around 70. So the difference is basically related to the activation income.
Yes, absolutely.
Okay. Sir, any insights on the broadband, how things are moving there?
See, broadband, we are at a gross sub level of 2.47 lakh subs, 247,000. We have close to 1.6 million home passes with us. We are getting a healthy when we say ARPU when it comes to Doxy. Our Doxy ARPU is close to 605, while EOC ARPU is relatively lower at 441, and we are looking at a blended ARPU of 481 for this quarter. Looking at this home pass base with 247,000 connections, broadband is more of in a stable zone, and we are in fact internally working on various plans on the whiteboard where we want to redraw the thrust which can be brought into broadband as a business segment.
Okay, so ARPU on an average basis 481. What was this year on year, sir?
Last year, one sec, I'll have to look into that number. What is last year's?
So almost it's in the same range.
Mayur, we don't have the last year's number as of now.
Not a problem, sir. I'll revert on that. I'll check on that later. And what was the 9-month content cost, if you can share with us, sir, on the cable side?
The 9-month content cost was around 447 crores.
Yeah.
Okay. Great, sir. Thank you very much and all the best.
Thanks.
Thank you. We'll take the next question from the line of Avinash Kumar from Moon Capital. Please go ahead.
Yeah, just a few follow-ups from my side. We can see that there's some cost benefits coming in this quarter. I mean, in employee cost is down and OPEX is also down sequentially. So, I mean, if you can provide more color as to going forward, how much more benefit we can see cost cutting benefits to flow down to the EBITDA, let's say next 2-3 quarters. How much of EBITDA expansion can be expect coming from this cost-saving initiatives?
Sure, Avinash. The way we are looking at the business right now is that we are measuring expense as percentage of our operating revenue. So like in quarter 2, it was at 91.4% to be precise, wherein in quarter 3, we have reduced it to 85.2. Now, effectively what has happened is that while our subscription revenue has gone up, we have made all the efforts to keep our expenses controlled to the sense that our expenses have been flat. In fact, my last quarter expense was 285 crores, quarter 2, and quarter 3 expenses at 287 crores. So while you grow the revenue, you keep your expenses flat, and this can only be done with with various process optimizations and cost control initiatives, primarily driven by a lean, agile, and focused team. So productivity and disciplined execution is one of the key focus areas, and I can assure you that this cost focus rigor will continue. You will see improvements here.
Okay, I mean, perfect. So where can we see, I mean, if you can provide some colors, EBITDA margins to be, let's say, next 2-3 quarters to be? I mean, see, your subscription revenue, which is the core revenue, is going up, which is a good thing. You're keeping a good check on your costs. So where can we see the EBITDA margins to be in somewhere, if you can provide some color on it?
Avinash, you will see the improvement, but it will be too early to give you the exact number.
Okay, completely understandable. And just to follow up again, I mean, we're talking about this try order for almost this whole of last 9 months. And the last quarter when we talked, you say, I mean, the grapevine says that it will be out so soon. So, I mean, we don't see anything happening. Can you provide more color? Will it happen in the 4th quarter itself or get pushed ahead? I mean, how is the things?
if I can ask for something from Almighty, this is one thing, because it will have a huge impact on business improvement. We all, as an industry per se, has been looking forward for this tariff order to be pushed out. But two things out here, Avinash, though there is no direct control anyone has, because it is with the judiciary. However, there are efforts being made by all the constituents to appeal to get this tariff order announced. And to give you the latest update, around a week back, collectively, IBF, which is Broadcasting Federation, AIDCF, which is All India Digital Cable Federation, and TRAI, the regulator, there was a joint mention made by all three of them jointly in Chennai High Court, saying that let the order be declared, let it be announced. And judiciary at that time, which was last week, had mentioned, in response to the mention which was brought in out there, that you can expect it to be announced very soon, which effectively meant this week while we are talking. But we are waiting.
If I remember our conversation last quarter, this is exactly what we heard is within a week or two, we can expect the order. I remember our conversation last quarter, so that's how it is.
I know from where you're coming. In fact, I don't want to say no control on that. Only thing we can do is keep on pushing the constituents, and that's where at Indian Habitat Center, led by the TRA chairman himself, there was a joint meeting between IBF, where all broadcasters were present, AIDCF, where all key MSOs were there, and DTH operators were there, and TRA themselves were out there. And there it was jointly decided that why don't we go collectively as a single forum and request for the judiciary to announce it. Hence, this mention happened last week, collectively by all three bodies. And we were assured that this week you should hear something. We are waiting.
This will be a big boon for the industry, I should say that. And if I can squeeze in a few bookkeeping questions here. What would be your capex for third quarter 18 and your capex guidance for next year, next quarter and the full year?
Avinash, Sanjay here. What we are looking at in the Q4 is close to about 50 to 60 crores of capex outlay for next quarter. And for the next full year, we are actually, in the state of drafting out our annual operating plan. So probably that we can discuss it offline.
Sure. And can you provide a breakup of this 50-60 crore? How much would be broadband? How much would be cable?
Out of this, for Q4, we are expecting about 15 to 20% to go into my broadband business, and the balance would be required for my video.
Okay. And what was the capex for this quarter, 3Q18?
This quarter, we have it's about 50 crores. Again, same ratio. Ratio was probably the same.
50 to 20% on broadband and the rest on cable.
Absolutely same.
Okay. Thank you so much.
Thanks.
Thank you. A reminder to the participants, anyone wishing to ask a question may please press star and 1. We'll take the next question from the line of Sanjay Chawla from JM Financial. Please go ahead.
Hi, thank you for the opportunity again. Just coming back to the pay channel cost or the content cost. For the first 9 months, it was 447 crores. And on a YY basis, this is a little more than 20% growth. So if we're going to see some uptick in fourth quarter as well. So I guess we are probably end the year at 20% plus on a full year basis. So my question is, what's changing in the environment or in the negotiations that you're doing that we are confident of having a mid-teen kind of a growth in the content cost going forward? That is one. And secondly, your net finance costs are down quite sharply on a sequential basis, even though your debt has gone up. So what has happened there? Is there any forex benefit that you got?
So finance cost, there was some buyer's credit which was there. So we have optimized on there was some high yielding loan have been repaid. So that was one of the big constraints. And also there was some expense, foreign exchange gains, which was there last time around, which is not there in this quarter.
And coming to content elements, Sanjay, as I said, that there is no fixed timing of content deals to happen. So a lot of content deals are undergoing negotiation. We have taken some bold stances in case of few negotiations which are happening, to the extent of going to RIO with some of the key broadcasters. So we are into very active negotiation with the complete focus that content cost is something which has to be curtailed. And as I maintain, when you see when we are talking same time for quarter 4 results, it should be somewhere in high teens and not beyond that.
Okay, high teens is what we should be realistically looking at most.
That's what I've been saying before also to you. Yeah.
Okay. No, I was under the impression that we are looking at not more than 15% growth. That's based on my past interactions, but yeah, I guess that's the new reality.
We'll be very happy it is 15, but why not 10?
Yeah, no, I mean, we have seen 20% this year.
And what if there is tariff order which is undergoing implementation 2 months down the line, then why even 10? So there are different scenarios we can always picture, but I don't think it should go beyond, I think.
Okay, got it. Thank you.
Thanks.
Thank you. The next question is on the line of Krunal Shah from Enam Investments. Please go ahead. Krunal, your line is unmuted. Please go ahead.
Hello. You able to hear me now?
Yes, sir. Please go ahead.
Yeah. Sorry, sir. I joined the call a bit late. The question may be repetitive. Have you given the phase-wise ARPUs this quarter?
No, we haven't, Kunal, but we can. So we have seen improvements in phase 3 and phase 4.
Okay.
Phase 1 and phase 2, it remains the same.
Okay.
Phase 3 has gone up marginally by 4% from 55 to 57. And phase 4 has gone up from 40 to 43, which is around 8%.
Okay. 40 to 43. Okay. And that's it. Thank you so much.
Thank you. We'll take the next question from the line of Amit Kumar from Investec. Please go ahead.
Yeah, thank you so much for the opportunity, sir. So I'm just trying to understand, on a QOQ basis exactly why the debt level has, gone up. Because when I look at your depreciation, you have a depreciation of just around 80 odd crores and a capex of about 50 odd crores. So it's definitely not coming on the capex side of it. Could you just explain the between 2Q and 3Q the increase in debt level? What are the 2 or 3 key line items driving it?
So one was the capex, which was about 50 crores, and the other one, the increase of the additional 50 crores was on account of working capital.
Sorry, 50 crores on account of working capital.
Yeah.
And what is the key line item in this working capital which is driving this?
Basically, there were certain payouts which were happening, which was broadcasters payments which was there, and that was driving. It was more so in the fag end of Q3.
So I'm sorry, the liability side has gone down is what you're saying.
What Sanjay is saying, that there was a 100 crore increase in debt. Broadly, it can be divided into 50 crore on account of capex and 50 crore on account of cash flow related stuff.
Yeah.
Within cash flow related stuff, you asked what was the key payment under cash flow stuff. It was more to do with some content payments to be made to broadcasters, which was done in December.
Okay, understood. All right. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Sanjay Chawla from JM Financial. Please go ahead.
Hi, I just if you could share the receivable level at the end of December, compared to September end.
Yeah, Sanjay, this is Ankit here. So the receivables is around 458 crores for 31st December, as of 31st December.
Okay. So this, this looks like a pretty steep increase. Is it driven by your cable subscription revenues mostly?
No, this is not an increase. We generally measure it as percentage of our DSOs, or day sales outstanding, and it remains flat. Obviously, it's in line with the in fact, when I look at our collection efficiency is one of the key measurables we are monitoring. And when I look at my collection efficiency in month of December, it's 95.4%. And when I look at my collection efficiency for the quarter, for XNL, it is close to 94.5%, whereas YTD was 90. So what you're seeing is because our subscription revenue is also growing up, so we generally measure the account receivable as percentage of subscription revenue in terms of days of sales outstanding. So it's flat.
No, I mean, in terms of the overall revenue that you have reported in third quarter, if I annualize it, this is translating to roughly 117 days, whereas in September we were looking at 106 days, what you reported. So there seems to be some uptick here in terms of days of sales.
I think we can exchange our calculations so that
we can take care of the calculations later, Sanjay. I think it has been
Sure.
Carriage thing.
See, look at it. We can look at your calculations offline, Sanjay. According to
Sure, that is good. Thank you.
Thank you. The next question is from the line of Avinash Kumar from Moon Capital. Please go ahead.
Yeah, just a small follow-up. I mean, it was like in continuation with what Sanjay asked. I mean, I can see your debt level going up sequentially. I mean, you gave the reasons why it went up. So by this FY18 end, where can we see the debt levels to be? I mean, can we expect any increase given the capex outflow?
So next quarter, we are not expecting any major movement in the debt levels, Nash.
Okay, so I mean, fairly constant at what we saw this quarter?
Yeah. So that's minus 20-30 crores, that would be there. I mean...
Okay, fair enough. And if you can share what will be your FCF, I mean, till now, I mean, 9 months FCF generated?
Avinash, I think, Ankit, can you just share it separately with him?
Yeah, I'll share it with you separately, Avinash.
Oh, okay. Not a problem. Okay. Thank you.
Thanks, Avinash.
Thank you. The next question is from the line of Krunal Shah from Enam Investments. Please go ahead.
Hello, sir. What would be our HD ARPU?
Can you just elaborate? What's HP ARPU? What do you mean?
HD.
Oh, you're talking about high definition.
HD ARPU.
Yeah, HD ARPU.
Oh, we have not calculated it separately right now. Maybe we have to share it.
We can get back to you on that, Kunal.
Okay, sure. And in terms of other expenses, were there any write-off of receivables this quarter?
No, not at all.
Not at all. Okay. And in terms of broadband, what would be the number of customers on the DOCSIS platform?
On the DOCSIS platform, we have around 106,000 customers.
Yes.
Okay. And any vision or in terms of the broadband business next 2-3 years or 5 years, can you share?
That's a very interesting question, Kunal. In fact, we are very bullish on broadband, but we believe that current shape and format of broadband as a business model, we are a bit skeptical. So right now, there is a complete captive team internally which is working. We have put them to go back on the drawing board. So we are chalking out some plans, trying to think about some disruptive innovations. And you will hear something from us with regard to broadband pretty soon. Something very different.
Okay, hope to hear it soon. Thank you, sir.
Thanks.
Thank you. The next question is from the line of Vikash Mantri from ICICI Securities. Please go ahead. Hello, Vikash.
Hello.
Yes, sir. Please go ahead with the question.
Yeah, sir. On the broadband business, I wanted to know how do we calculate home passed, and what is our ideal penetration ratio that should be there?
Effectively, the ideal penetration ratio, I'll be happy if it is 100%, but that's not the way it works. But home pass is generally the connectivity, basically. The number of houses where we are ready to provide the broadband speed, that's home pass. Addressable, what we call, where your network is present and you can get inside the house. And ideally, we should be able to get into maximum number of houses.
So let's say if you put in a network on a lane, houses on either side of the lane becomes a home passed, is it?
Within the addressable reach, yes, absolutely.
Okay. Fair enough, sir. Thank you. That's all.
Thanks.
Thank you. The next question is from the line of Amit Kumar from Investec. Please go ahead.
Yeah, thank you so much for the opportunity again, sir. Just on this order, we're just doing some math and, I wanted your comment on, whether we are sort of right, wrong, or, how to sort of look at it. So when I look at your content cost, about 170 crores in the trailing quarter at around 11 million active subscriber base turns out to be around 52 rupees, per subscriber. And when we look at, that reos which, different broadcasters, at least the pay broadcasters, the large pay broadcasters that put out, we were looking at, the popular channels, anywhere between, on average, anywhere between 9 to 10 rupees, per channel, net of, commissions and discounts, around 6-7 rupees. So that's just about, 9, channels, on average, a consumer has to take for broadcasters to make, broadly what they were, 8 or 9 channels broadly for broadcasters to make what they were making, earlier. And given the fact that there are almost 200, pay channels, out there, I mean, that doesn't seem like a very high, number. I mean, consumer definitely does take, or just does watch, those many, pay channels. So I'm just trying to understand what changes, even if this try order gets sort of implemented, and what changes from your perspective? And whether this math sort of broadly, I mean, you agree with the math, or you think that, something is off here?
Not at all. I don't agree with your math. I'm sorry to say so. I mean, this is something we monitor day in, day out. Our content cost, we generally look at it at a net basis, which is content minus carriage, and then we arrive at a net content cost. When you look at my financials, just to put your maths right, our content cost was 447 crores on YTD basis, 9-month basis, and my carriage was around 230.4. So my net content cost was 216.8 at a sub base of 11.32 million active. So probably you're taking at 11 million. It's 11.32 million active sub base. So on that basis, my net content cost arrives at 21.3. You were talking about 52, so I got scared. No business can run at 52. So my net content cost is around 21.3. And then there are other OPEX, and that's how we run this business. So that is about the maths part. Now, taking maths behind and going to TRI order stuff, there are 2-3 things which are very interesting in TRI order, which should change the game according to us. So while you spoke about ordinary customer picking up 9 to 10 channels, and based on that it should happen, I have 2 observations out here. One, there is a kind of pipe charge which TRI has allowed in their order, wherein there is a minimum of 125 rupees to be paid for FTA channels. So that money has to come to MSO anyway, even if your content cost is 0. That's one. Second, how so many number of channels a customer may choose to take? It's all pass-through cost for me. So if my cost gets passed through, and there is a fixed pipe charge anyway to take care of my other costs, it becomes cost neutral to me. While today it's a big expense on my balance sheet. And in addition to that, my presumption of what I have understood about the tariff order, broadcasters are going to come forward with lean packages, they call it. So there you could see certain small chota packs of 8 channels, 9 channels, 10 channels, depending on various broadcasters, at very differential pricing, which is permissible under TRI tariff order. So there will be very few cases where you may see vanilla 9-10 channel pass through in addition to FTA channel. That's my thought around it. That's one. Second, what we guys are more gung-ho about, your understanding of the local dynamics out here will play a critical role, because suddenly the whole game is changing from push to pull. So currently, when broadcasters today do their deals, they do on lump sum basis with complete, let's say 40 to 50 channel bouquet on average between top 4 broadcasters. So they give you 40 or 50 channel bouquet, and then you have to pay a fixed cost. Now pushing 50 channel will become a very difficult phenomena. And you will have to, as a broadcaster, you'll have to create some kind of pull with the consumer to subscribe to their channel or to their chota packs, lean packs, whatever they're trying to cut through on. And for that, your whole accessibility to the consumer will play a critical role. And I think there will be shift of go-to-market strategy from broadcaster to intermediaries like MSOs and DTH. Very different game altogether. I think your local understanding of the markets, local geographies, and your systems, processes, and customer centricity will play a critical role.
So I take your point on the fact that there's a pipe charge which has been allowed of 125, but in fact when I do the math your way, which is content minus carriage, today you are at a net of 21. And given the fact that carriage has been sort of limited at a very sort of nominal amount, and that too to the extent that channel is not picked up by more than 20% of the consumers. I mean, that element is actually going to come down for you, right? Carriage and placement all sort of put together.
There would be reduction in carriage because carriage is not being called carriage in the tariff order. So what has been defined is it's 20 paisa per channel, and then it has been further linked with the penetration levels. I hope you understand that clause they have put in.
Yes.
So that will definitely put some pressure on the carriage. But then there will be other parameters. There would be things like promotional activities. There will be various other kind of charges will come into play, and then the choice of placing free-to-air channels on that pipe of 125 lies with the MSOs or DTH and not with the broadcasters. And beyond that, this new regime would be more of marketing, selling, and sampling your product to consumer. And it will not be pushed through where people like you and me may get 300 to 400 channels on our TV sets while we may not be watching more than 20. And if that has to be done, it has to be done in a collaborative manner. And collaboration there also will depend on the knowledge sharing. And that knowledge sharing in terms will also depend on your people equation within the organization, process equation within the organization, the customer centricity drive you're trying to put in place. Do you have right kind of service and equipment out there to handle that kind of load? And that's where the quality and quantity will stand to be differentiated. Very different game altogether. I believe it can be a positive thing for broadcasters / MSOs / DTH, provided you execute it right.
Okay. Just sort of final point, and then I'll leave it for others. But I mean, you already have those promotional activities. Given that you already have almost an 80 crore carriage and placement income, annualize that almost 320 odd crores. So those promotional, I mean, there is a fair bit of those promotional activities. So to speak, placement.
Where are you seeing those activities? Please introduce me with those activities.
Sorry?
I mean, as a consumer, what are the activities you're looking at right now? I generally keep on telling my team that tomorrow you will be getting into a time where a grandma from a house will call up your call center and say, "Beta, I need that channel on which you are showing Mahabharat." Now your call center agent doesn't know which channel out of 400 channels is showing Mahabharat today. And where are you seeing the promotional activities? I'm sorry to say so, Amit, but I haven't seen any. Today, carriage is more of a carrying cost and the cost of LCN. It's nothing to do with marketing or promotion.
Okay. Understood. That's it from my end, sir. Thank you.
Thanks.
Thank you. The next question is from the line of Rajiv Sharma from HSBC. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just trying to understand this, a little bit more on the tariff order. First is, there is a view that MSOs generally are not ready with their systems to really provide that kind of, a la carte or chota packs or individual, mapping of channels. So what's the reality there? Means, are we somewhere in the middle? And second is, basis that also there is another assumption with the investor community that, and the broadcasters have been saying that even if you look in telecom today, post Jio has been there, you have unlimited plans which is proliferating, and now they are 20% or 290 million subscribers on that plan out of 800 unique subs. So we are gradually, that's what's going to happen. What is there in telecom, and media will move in the reverse way from bundle to unbundle. So will that really work? I know there is a lot of push of content today, customer choice is missing. So the view is that MSOs may not,
really go and implement it out, or the DPOs and we'll continue with these kind of packaging, bundling which exists today. There will be 5 bundles instead of 3. So your, thought process there, as a MSO community, is it really thinking to take a stand here, go out and implement this, other systems in place, then only all this upsides will come. Otherwise, will be status quo with marginal upsides.
Fantastic. I mean, it was really, Rajiv, great to hear your views. Now our views on the subject. Are MSOs ready? I can talk about 3 or 4 big MSOs, and my answer collectively would be yes, because we have been exchanging notes on this day in, day out. Proof of the pudding? In fact, many of us have already started testing the market. We have been, we have a significant base in eastern part of the country. When you look at West Bengal, Bihar, Jharkhand, Northeast, we have a very substantial subscriber base in that belt. And we have been moving on RIO, a la carte since 23rd or 24th of December. It's almost 1 month now. So taking a base of close to 5 to 6 million subscribers on a la carte or on RIO, which is going to be reality soon, over last 1 month in that part of the country, has given us significant learnings. A. B. It doesn't stop there. We have a significant base in this part of the country with, again, close to 5 to 6 million subscribers. So we have taken another broadcaster, a different broadcaster, on RIO basis, a la carte basis, in this market. So we are experimenting with 2 broadcasters. And again, that has also thrown up significant learning opportunities for us with regard to our systems, with regard to our ability to manage 11 million plus customers while we are putting broadcasters on a la carte and trying to do various juggleries with regard to what we need to push in the market or not. C. We recently, in first week of Jan, if I'm not wrong, I think 2nd of January, we announced new packages. For the first time, we, as a MSO, we have moved on packaging, and we have announced 4 packages in these markets, giving options to our consumers, and that packaging options have also given significant insights into what we need to do. And to be very, very candid on this call, we actually ended up ordering a few more servers, realizing that while we are juggling with 11 million base, experimenting with these 2 broadcasters and looking at the demand level which will come up, what are the flaws or what are the plugs we have to put in play when it comes to my own process, my own systems, my own interfaces between my server base in my headquarters versus the way my operators and distributors are interfacing with it. So a lot of changes are happening while we're talking on that front, taking out these learnings of last 1 month. And one of the key reasons of going behind this is to check the preparedness we guys need to have with regard to our systems and infrastructure base. In addition to that, we used to have our own in-house call center of around 30 people. We have gone external. We have hired a new call center in end of December, middle of December, I'll say. 15th December we did that, wherein we put a team of more than 50 odd people. And while we are going through this exercise with 2 largest broadcasters in the country, our call center team is going through that complete learning process right now. So when it comes to preparedness, we are extremely gung-ho, both when it comes to our support staff and while it comes to we people running the business. So that's one. And when I exchange the notes with my peers in MSO industry, so are they. In fact, one of our fellow MSO is already undergoing similar experiment with one of the broadcasters. Now, coming to bundle to unbundle, I think as a consumer, that's what I want. It's very different from telecom industry. When you talk about media, it's all basically what am I doing as a consumer? I'm basically consuming the content which you are supplying through your platform to my screen. Now, while you are supplying that content, and I am a consumer who has to consume the content has to be of my choice and my appetite. You can't push me 400 channels while many of your channels are tail-ended channels, which I may never even like to consume. It's like you give me a huge platter with 20 different vegetables lying out there in front of me. I don't need all that. So obviously, bundling to unbundling is the answer. While bundling to unbundling happens, the biggest worry which many broadcasters will have is what will happen to their tail-end channels? What will happen to various news channels? It's all about Me Too. There's a lot of Me Too stuff which is available across various genres across the industry. And when you look at those genres, each genre may have more than 15 to 20 channels, while your appetite may be addressed by having 3 to 4 top channels out of that genre, which may take total count to 20, 25, 30 at best case, even if you look at a genre-wise analysis. So I'm a big believer, having worked at both broadcasting side as well as the distribution side, that your knowledge of local geography and how are you addressing your segmented base. So there are two kind of MSOs or DTH players. One who are very I'll call it local centric, who may be having a deep presence in a particular marketplace only, and they had been enjoying good content price virtue their monopoly on that base itself, where 70% of consumer base is controlled by them in that particular geography. These guys will lose that monopoly advantage. While there are various MSOs whose base could be spread among pockets wherein you may be controlling 1, 2, 3, 4 odd pockets across the country. Now your understanding of these 4 or 5 pockets where you have a concentrated base, and then your ability to modify the offering of various broadcasters in all those 4 or 5 markets will become a major game changer for you guys. And that's where we are very gung-ho. If you look at my presence, we are deeply seated in south of country, we are deeply seated in north, we are deeply seated in east. And we are not one state specific players. I hope it answered your question. A longish answer to your question.
Yeah, it does, and that's very helpful. Thanks on that. So you think that bundling to unbundling will make sense, and there will be no going back to bundle because of system issues and because of strategic approach, know that it's better to have a higher share of wallet from the consumer rather than go to unbundling and have a low ARPU.
Absolutely. Why are we into business? See, the biggest pain area today for anyone's balance sheet when you come to delivery platform community is the content cost. That's the biggest cost element for me. If the content cost not only becomes passed through, but also gives me an opportunity to segment it in a way that it starts adding up to my revenue lines, why not?
And in your agreements with LCOs, which is very flat rate, per customer 100 rupees or 130 rupees, how will that pan out? Because every customer, every house will be differently charged. And that unless that is sorted, and you've taken 4 years to sort this 130 out as an industry. So, this will be new for LCO, and he's seeing DTH doing this for long, but that doesn't help him. How do you see that playing out?
Rajiv, fantastic insight. This was one area which was hitting our minds in the last few months, that how do we make our LCO part of this whole arrangement, and how do we, in terms of alignment, align him with our systems and processes in the way that he's able to put those packages demands into the system directly on his own, rather than my team getting across to, let's say, if not 11, 12 million customers tomorrow, and telling them that this has to be done. So we introduced something few months back called Own Your Customer, OYC. It was introduced in fact in March 2017, if I'm right, or January 2017. So under OYC concept, these LCOs have an access or to limited access to my servers and systems, wherein sitting in their own offices, they can change the packages and prices for, the packages for various consumers depending on what is the uptake of that consumer. And in fact, while we were going through this, I don't know what is the right word, for loss of words, I'm calling it experimentation or learning exercise with 2 large broadcasters which are doing right now, we gave that access to our local cable operators and distributors, and they really tested it how it works, and there were again improvement areas, not to deny that, and that's what I meant when I said that the interface between the server and the LCO is something where we are working upon. So they have gone through that exercise since December now.
No, my last question is basically he's getting 130, but in the new scenario, how will you split? Because you are saving on content cost, it's becoming a pass-through. You straight away getting a markup. So you will split the 125 maybe 50/50, and then whatever is incremental, and you'll have to have billing systems. And so is that the way it will play out between your revenue share between both of you?
Rajiv, I think this is something which has to be discussed between us and our partners, and not on the call.
Okay.
We'll let you know the way it phases out.
Okay. Thank you so much.
Thanks.
Thank you. The next question is from the line of Vikash Mantri from ICICI Securities. Please go ahead.
Interesting discussion, sir. So I thought I need to come back. You made a statement that this tariff order will be positive for broadcasters /MSO/DTH, and whether the LCOs were missed in this point. That was an oversight, I would say.
No, because no, it was just a reference, no deliberate attempt. But I think what you said is half of my statement.
Okay.
I said this will be positive for the community. Now let me add all four in the community.
Very fine. So my question goes forward. So
no, but that's not the complete statement. The complete statement was it was positive for the community provided you execute it right.
I know the provided it was there. No, my question therefore is this: can you help us work out the economics of the LCO? Because our entire working says that somebody has to be worse off if everybody is saying they'll be good with it. And therefore, the equation that works out is the LCO will not end up, because if you are counting the pipe income on your end, then where does the current monies that the LCOs are making stay put?
No, because I have no intention to make it controversial in any way, if that's the attempt.
Why would I make it controversial?
The point out here is there are various MSOs, there are thousands of LCOs, there are various broadcasters, and obviously the EBITDAs or PATs or revenues are not same for everyone. The business performance of each organization, each business unit, changes due to various internal and external parameters. So obviously there will be people who will gain, there will be people who will lose. But broadly, from business model perspective, whosoever executes it right, it stands to gain. We are very clear on that. We're very clear, whether it's LCO, whether it's MSO, anyone.
Your sharing with the LCO in the new regime remains the same or improves?
Because I think that has to be discussed between us and our partners.
No, sir. The point is, as an analyst, my job is to forecast how does this equation change, and that is why we are requesting your help here. Because
let's take it offline, because.
Okay.
Thank you. The next question is from the line of Avinash Kumar from Moon Capital. Please go ahead.
Yeah, hi. Thank you for a detailed discussion on TRAI order. It was very insightful, I should say. So that answers, because I was about to ask, how is the city or other MSOs prepared on ground to implement it? Let's say if the order comes down maybe 2-3 weeks down the line. So that's very insightful. Thank you for that. Just a few follow-ups left with me is, is there any equity raising coming from Citi going forward? Because you need investments in your systems, you need investments to up your billing, and a whole infra will change post a TRAI order. So any equity raising plan? And second would be, post a TRAI order, the market will synchronize. A lot of investors will look at this sector, which was not a very good sector to look at in the past, if I can put it that way. So any M&A opportunities coming into the sector post a TRAI order when things synchronize and there's a good overflow for the whole sector?
Avinash, I can talk from my organization's perspective. We are part of a large group with a huge market cap. So fund is never a challenge. If we see an opportunity and there is need to raise funds in whatever shape and format, that option always remains open for us. So that's not something which worries us big time. And as you said, with regard to merger and acquisition opportunity, yes, there are. And there are many M&A opportunities in the marketplace. And I totally agree with your thought that as and when things start working in more synchronized fashion, which hopefully they should after the tariff order implementation, there are various opportunities, and there are opportunities on table even today. And we, as an organization, also keep on evaluating them.
So will you be comfortable sharing it on a public call? About the M&A opportunities that you
have on the table? There are opportunities on the table, and as any organization, you keep on you keep on checking those opportunities, how useful they could be and what could be the right timing. So that's part of ongoing business.
Okay.
And
Perfect.
when they reach a stage where we need to make public announcements, we will.
Okay. And no equity raising plans as of now on the table. It's like
not on immediate basis.
okay. Thank you, Rajesh. Thanks.
Thanks.
Thank you. We'll take the next question from the line of Mayur Gatani from OHM Group. Please go ahead.
So just on the try order, hoping that it comes in soon, what are the possible likelihood that, you may, some MSOs may not like it or the broadcasters may not like it and they may take it to court or to any other body where they can, raise an issue with it and hence again delay the whole process?
You see, the strategies would be internal to each organization, as you may appreciate. But
right.
what broadly, informal basis, the notes we keep on exchanging at the industry body. When I say industry, I'm talking about the complete ecosystem, broadcasters or DTH or LC or MSO, everyone put together. I think the majority wants this tariff order to be implemented. This is what we have understood so far. And as with regard to the legal options people may like to adopt, anyway, it was taken to the Supreme Court, and Supreme Court routed it back to Chennai High Court, and now it's awaiting announcement by Chennai High Court, as my friend Avinash was pointing out, from almost a year now, 9 months to 12 months. And post that also, if someone wants to challenge them, and from my limited understanding, and I'm not saying it's absolutely accurate, they may take it back to the Supreme Court. But I think once Supreme Court only has directed Chennai High Court to look into it, going back to Supreme Court may not be a long haul. You may see immediate closure. This is what my limited understanding says, though I'm not the expert on legal aspects.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Ankit Sen for his closing comments.
Yeah, hi, this is Ankit here. Hope we were able to answer all your queries. If you feel there are some further queries and questions which you would like to ask management, you can get in touch with me and Investor Relations, and we'll be happy to answer the same. Thanks, and have a good day.
Thank you. Ladies and gentlemen, on behalf of Siti Networks Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.